Okay. Anyway, moving on now to our last trade, which we're gonna go back to TastyWorks in a second, guys. How we're gonna show this on the platform, but we're gonna talk about the short call option payoff diagram. The short call payoff diagram. Remember the put option I showed you guys before? Okay, this was our short put option diagram. The short put option, okay, our maximum gain here was our premium. The maximum loss was with the stock going to zero. Remember, for the short put, the short call option, guys, again, one thing different here, which it is the maximum loss, which can be infinite. Why? Because remember, the long call option, maximum gains infinite. The short call, maximum loss, infinite. Because if this thing here goes to infinite, this person will have infinite losses. Okay? And of course, like I always say to you guys, the maximum gain of an option seller, in this case, short call option seller, it is equals to the premium received to open this trade, which you're gonna see right now, an example how to trade a short call option. So here, we're going to sell an option with a strike price of 150. We're going to receive $8 per share. So the initially margin for this thing here will be $1,500,000. Assume 20% the strike price. This will be in the case of the margin of the portfolio that I said to you guys before. Okay, because this is what most of the brokers will require from you to open the trade. Roughly 20% of the strike price. Okay, very crucial that you guys do understand. But again, for those of you that have cash account, selling short call option is never a great idea. On a small account, guys, it's even worse. Just don't do it. Okay, just don't do it. Short call option, you can get very stink if you don't know what you're doing when it comes to short call options. Okay, so after 80% of the premium being realized, the option price has dropped to $1.60. I mean, realized because we closed the trade. So basically, we made $8 that we sold for. We bought back for $1.60. We made $60.40. Okay, for those of you that didn't have a clue what I talk about, so basically, I'm gonna show you guys in a sec on TastyWorks. Anyway, we sold to open and we bought to close. Okay, sold to open for $8 and bought to close for $1.60. We capture here the difference and multiplied that by our option multiplier. We made $640 because we made $640 per share and there was a single contract. Our rate of return, of course, in this case, the broker asked us to have as a buying power required $15,000. We made $60.40 multiplied by 100, 4.27 rate of return or rate of on capital, whatever you guys want to call it. Okay. And of course, now you calculate the annualized rate of return for 2 months. That's how long we hold this option. You can do that for 1 month, you can do 14 days, it doesn't matter. So we get here our rate of return, multiply here by the trading days, trading years, trading weeks, and divide for how long we hold here, which was 2. 2 is basically, guys, okay, our days in the trade. Simple. We have days to expiration when you open the trade, and when the time goes by, this is the days in the trade. So for those of you again wants me to do the 0.427 multiplied by 365 divided by 2 months, let's call that 60 days, and then we're going to multiply everything by 100 just to make things more sexy for you guys. It's gonna be 25.97. If we do here 365, sorry for my writing, divide by 2 months of 60 days, okay? That's gonna be roughly 25.97%. Pretty much same. I do weeks and days, weeklies and things like these, guys, in terms of weeks and months, 12 and 52, just to make things easy on the presentation.